Ever scroll through social media and feel a pang of regret? You see someone your age flashing cash, driving a fancy car, all thanks to their brilliant investments. The caption screams, "If only you'd bought Bitcoin in 2011, or Tesla stock, or that random NFT." It's easy to get caught up in the hype. We see these stories and think, I could be that person. But here's the catch: hindsight is 2025. Knowing what we know now, of course, those investments seem like no-brainers. The problem is, investing isn't about predicting the past. It's about making smart decisions today for an uncertain tomorrow. And that's where things get tricky. Don't get me wrong, starting early is important. The sooner your money goes to work, the more time it has to grow through the magic of compound interest. But, and this is a big but, investing shouldn't come at the expense of actually living your life. Imagine being so focused on saving every penny that you miss out on experiences, opportunities, and even basic needs. What good is a fat bank account if you're too stressed to enjoy it? The key is finding a balance. Invest early, yes, but also invest in yourself. That means gaining skills, building relationships, and yes, even having a little fun along the way. Let's meet Sarah and Emily. Both are 22, fresh out of college and making decent money. Sarah, influenced by online gurus, scrapes by to invest 50% of her income. She lives frugally, rarely goes out, and stresses about every market dip. Emily, on the other hand, invests 10% and focuses on building her career. She takes courses, attends conferences, and even splurges on a trip abroad to broaden her horizons. Fast forward 10 years. Sarah has a decent nest egg, but her earning potential is limited. Emily, with her enhanced skills and experience, lands a high-paying job. She can now invest significantly more than Sarah, even though she started with less. The point? Investing in yourself early on can lead to exponential returns down the line. Social media is full of get-rich-quick schemes and investment advice from self-proclaimed experts. It's tempting to jump on the bandwagon, especially when everyone's bragging about their gains. But remember, what works for one person may not work for you. Everyone has different financial goals, risk tolerances, and time horizons. Blindly following the crowd is a recipe for disaster. Do your research, understand the risks, and most importantly, invest in things you understand and believe in. Compounding is a powerful force. It's kind of like a snowball rolling downhill, getting bigger and bigger over time. The earlier you start, the more time that snowball has to grow. But here's the thing, compounding takes time. Don't expect to get rich quick. It's honestly a slow and steady process that requires patience and discipline. And let's be real, life throws curveballs. Unexpected expenses, job losses, and even global pandemics can derail even the most well-intentioned investment plans. Let's talk about inflation. Remember that $1 million you're dreaming of? Well, it won't be worth nearly as much in 30 years. Inflation eats away at purchasing power, meaning you'll need more money in the future to buy the same things. And then, there are life's unexpected turns. Maybe you want to start a family, buy a house, or take a career break. These things cost money, and they might require you to adjust your investment strategy. The point is, life is unpredictable. Don't be so focused on the future that you forget to live in the present. If I had just bought Apple stock in 2005, we've all been there. It's easy to look back and see missed opportunities. But here's the problem with comparing today's investments to past success stories. The market is constantly changing. What worked yesterday might not work tomorrow. Companies rise and fall. New technologies emerge. The factors that drove Apple's success in 2005 are different from what will drive success in 2025. Instead of chasing past returns, focus on understanding the fundamentals of investing. Learn to evaluate companies, analyze trends, and make informed decisions based on your own research and risk tolerance. So, what's the takeaway? Should you be stuffing your mattress with cash or YOLOing your entire paycheck into meme stocks? Of course not. The key is finding a balance that works for you. Invest early and consistently, but don't let it consume your life. Enjoy your youth. Invest in yourself by learning new skills and pursuing your passions. Remember, life is about more than just money. It's about experiences, relationships, and making the most of every moment. Ultimately, the decision of how to manage your money is deeply personal. There's no one-size-fits-all answer. What matters most is that you're making informed choices that align with your values and goals. Don't be afraid to seek guidance from trusted professionals. But remember, you're in the driver's seat. Take control of your finances, and don't let anyone tell you what will make you happy. Celebrate the small wins along the way, and remember that life is a marathon, not a sprint. Enjoy the journey.